Hello, welcome to the A Book a Day channel. In this video, we bring you a book called One Up on Wall Street, How to Use What You Already Know to Make Money in the Market. Peter Lynch is one of the most successful fund managers in the world. How successful, you ask? Some say his contribution to the fund industry is akin to Michael Jordan's contribution to basketball. The Magellan Fund he managed achieved an annual compound return of 29%, breaking the record in the U.S. mutual fund industry. In this book, Peter Lynch shares his complete philosophy and method for selecting stocks, essentially revealing the secrets that made him the most successful fund manager. The most acclaimed aspect of Peter Lynch's approach is his method for choosing tenbaggers. Tenbaggers are stocks that are expected to increase in value tenfold over the next 10 years, what we commonly refer to as blockbuster stocks. He elaborates on this method in detail in the book. Investment guru Warren Buffett has always held Peter Lynch in high regard. Shortly after the book was published, Lynch received a call from Buffett, who said on the phone, "I just finished reading your book, and I really like it." The fact that Buffett praised it so highly speaks volumes about the exceptional qualities of this book. In the following time, I will explain Peter Lynch's entire investment method in detail. I will divide it into 3 key strategies. The first is how to pick tenbaggers, the second is which stocks to avoid, and the third is how to master the timing of buying and selling. Let's look at the first key strategy. Picking tenbaggers, which are stocks that increase more than tenfold in a relatively short period. During Peter Lynch's investment career, he placed great emphasis on uncovering tenbaggers, which may be related to his first experience in stock purchasing. He bought his first stock, Flying Tiger Airlines, in his sophomore year of college at a price of $7 per share. In less than 2 years, the stock price rose to over $30. His first ever stock purchase was a tenbagger. This successful experience solidified his belief in finding blockbuster stocks throughout his decades-long investment career. In the book, Peter Lynch boldly states that ordinary people, or amateur investors, have an advantage over professional investors in identifying tenbaggers. At first glance, this seems like a radical idea. In fact, Lynch's original statement is even more exaggerated. 20 years of experience in the investment field have convinced me that any ordinary amateur investor, using just 3% of their intelligence, can achieve investment returns that surpass the average performance of Wall Street investment experts. This is indeed inspiring for millions of ordinary people. However, inspiration alone is not enough. In the book, Lynch thoroughly explains why he believes amateur investors have an advantage in stock selection. A crucial reason is that the actions of Wall Street professionals often lag behind. Lynch notes that Wall Street professionals typically wait until a stock is recommended by many famous analysts and their peers start buying in large quantities. For example, a clothing company that went public in 1969 initially went unnoticed. After 6 years, when it had opened 100 stores across the U.S., only one institutional investor had bought its stock. 4 years later, only 2 institutional investors had bought in. 14 years after its IPO, when the company had opened hundreds of stores and was thriving, its stock price had increased 18-fold to $9, but it still hadn't attracted significant attention from Wall Street. 2 years later, when the stock price had risen 30-fold to $15, Wall Street institutions finally started paying significant attention. Why do Wall Street professionals lag so much? Lynch believes it's because they generally don't dare to risk buying stocks of lesser-known small companies. He gives a vivid example. If you buy IBM stock and it falls, your clients and boss will ask, "What's wrong with IBM lately?" But if you buy stock in an obscure motel chain and it falls, they'll ask, "What's wrong with you?" Due to the immense pressure of investing in little-known small companies, independent thinking is extremely difficult among professional investors. Therefore, Lynch says he continues to think like an amateur investor when selecting stocks. So, how should an amateur investor choose stocks? Lynch famously said, "The best place to look for tenbaggers is right in your own backyard, and if not there, then in the major shopping centers, especially at your workplace." Imagine someone living in rural America in the 1970s, farming and without a TV. Where would they find tenbaggers? Maybe one day they suddenly have stomach pains and have to see a doctor, leading to a diagnosis of a stomach ulcer due to rural life. This could lead them to discover a tenbagger, Plow Corporation. At the time, millions of Americans had heard of or used their stomach medicine, Tagamet, which sold well after its release. Plow, the company that introduced Tagamet, became a tenbagger. It sounds easy to find tenbaggers, right? But don't get too excited yet, because the truth is that most people don't do this, and even Peter Lynch regretted missing out on blockbuster stocks in his own industry. In 1977, Lynch was working at Fidelity during a booming phase for the entire fund industry, with many companies going public, for example, the fund company Dreyfus had a stock price of 40 cents in those days, which rose to nearly $40 by 1986, a 100-fold increase in 9 years. Lynch, an insider in the industry, missed buying this company's stock and lost a great opportunity. People seem reluctant to buy stocks in their industry or ones they are very familiar with. Lynch describes this phenomenon. Generally, if you survey doctors, I bet only a small portion of them own pharmaceutical stocks, while most own oil stocks. If you survey shoe store owners, the majority probably own airline stocks instead of shoe industry stocks, and conversely, aerospace engineers may own more shoe industry stocks. This is paradoxical. Stocks are like the grass in front of one's house, where people always think the neighbor's grass is greener. So, to find tenbaggers nearby, you first need to overcome the misconception that the neighbor's grass is greener and then figure out how to capitalize on your own advantages. How should one do this? Lynch further categorizes companies into 6 types: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds. Hearing 6 categories might be confusing, but don't worry, the areas that are most likely to produce tenbaggers are primarily 3 types: fast growers, asset plays, and turnarounds. Moreover, when analyzing a specific company, different types require different methods of analysis. Next, we'll focus on these 3 types of companies that are most likely to produce tenbaggers. First, let's consider fast-growing companies, which are often the breeding grounds for tenbaggers and Peter Lynch's favorite category. These companies are usually newly established, small in scale, and have good growth prospects, with an average annual growth rate of 20% to 25%. If you can select the right ones, you might discover stocks that can increase tenfold or even 100-fold in value. The advantage for amateur investors is significant, as their account sizes are generally small. Finding just 1 or 2 such stocks can significantly boost their overall performance. However, it's important to note that these types of companies, due to their small size and limited strength, carry higher risks than average companies. You could easily fall into a trap. The key to analyzing fast-growing companies is to look at their replicability, whether they can replicate their success in one place to another. A classic example is Walmart during its expansion phase. As the company continuously opened new markets and rapidly increased profits, its stock price also soared. Lynch advises that the trick to investing in these companies is to figure out when their growth period might end and to sell the stock before the rapid growth phase concludes. Next, let's look at another category prone to producing tenbaggers: turnaround companies. These are companies that have been severely hit, are struggling, or are even on the brink of bankruptcy. Investing in such companies is risky, but once a turnaround occurs, they can become blockbuster stocks. An added advantage of investing in turnaround stocks is that their price movements are often less correlated with the overall stock market. In the 1980s, the famous automobile manufacturer Chrysler found itself in a difficult situation, nearly bankrupt, but then recovered with government support. Lynch made a significant profit for the Magellan Fund by buying Chrysler stock. He began purchasing Chrysler stock at $6 in early 1982, and within 5 years, the stock price had increased 15-fold. In addition to fast-growing and turnaround companies, there's another type of company that can produce tenbaggers: asset play companies. These are companies that have valuable assets you've noticed, but that Wall Street professionals have overlooked. Lynch once visited an ordinary small cattle ranch in Florida. At first glance, he saw nothing but short shrubs, a herd of grazing cattle, and about 20 employees. Where were the hidden assets? In the land. 10 years later, just the land itself was worth over $200 per share. This is a typical example of an asset play company. To recap Peter Lynch's first investment strategy, picking tenbaggers, he believes that amateur investors are not at a disadvantage compared to professional investors in identifying blockbuster stocks. In fact, they may have an advantage. The 3 types of companies most likely to produce tenbaggers are fast-growing companies, turnaround companies, and asset play companies. Now, let's delve into Peter Lynch's third investment principle: mastering the timing of buying and selling stocks. First, let's examine 2 common mistakes in buying and selling stocks. Some investors habitually sell winners, stocks that have increased in price, and hold on to losers, stocks that have declined in price. Lynch considers this strategy foolish, akin to pulling out flowers and watering weeds. What about the reverse strategy, selling losers and keeping winners? Lynch argues that this approach isn't much smarter. You might be wondering, if neither strategy works, what should you do? The problem with both strategies is that they rely primarily on current stock price movements as the main decision-making criteria. So, if not just stock prices, what should you consider? According to Lynch, you should analyze the company's fundamentals to determine whether the stock price is overvalued or undervalued. If it's overvalued, sell. If it's undervalued, buy. This approach closely resembles Warren Buffett's value investing strategy. Lynch adds 2 specific times when you can likely find undervalued stocks. The first is at the end of each year when many investors sell losing stocks for tax reasons, potentially leading to bargains. The second is during stock market crashes or significant downturns, which occur every few years and often present opportunities to buy undervalued stocks. For instance, in October 1987, the U.S. stock market crashed, and almost all companies' stocks plummeted. Lynch missed a blockbuster stock in his industry, Dreyfus Corporation, whose price had risen significantly due to rapid business growth. During the crash, Dreyfus's stock price fell along with the market, at one point valuing the company's business at almost $1 per share, practically a giveaway. Lynch seized this opportunity, buying the stock during the market downturn, and saw a 60% increase in its price within a year. Now, let's consider the timing of selling stocks. A common mistake investors make is selling a blockbuster stock too early. Let's look at Lynch's experience with Toys R Us, where he sold too soon and missed out on significant profits. Toys R Us, an excellent toy retailer, expanded rapidly in the U.S. during the 1980s. After thorough research, Lynch bought many shares at the equivalent of $1 per share. However, soon after his purchase, he read news that a retail industry magnate had bought 20% of Toys R Us, causing the stock price to rise. Lynch thought that once this magnate stopped buying, the stock price might fall, so he sold all his shares around $5. By 1985, the stock had risen to $25 per share, a 25-fold increase in just a few years. Unfortunately, Lynch only made a 5-fold profit. In contrast, his colleague who recommended the company, Peter Lynch, held onto Toys R Us and eventually earned a 25-fold return on investment. This example shows that when you're confident in a company's long-term prospects, you shouldn't sell its stock for short-term reasons, as you might not be able to buy it back at the same price. You might wonder if there's a way to sell stocks at their peak. Unfortunately, no such method exists. However, Lynch shares his experience in deciding when to sell. Think about it as you would about when to buy. Determining when to sell essentially boils down to 2 points. First, revisit the reasons you bought the stock. If the original reasons no longer exist, it's time to sell. For instance, if you bought a fast-growing company's stock because it was rapidly expanding into new markets and its profits were growing quickly, sell when this growth slows down. Similarly, if you bought a turnaround company's stock because it was in crisis but had potential for recovery and its price was greatly reduced, sell when the crisis is over and the stock price has significantly increased. The second point is to compare the value of the stock you own with other stocks in the market. If other stocks offer much better value, it's time to sell. Lynch's thinking aligns with that of Sir John Templeton, another investment expert. When asked when to sell a stock, Templeton said he would do so when he found a better value. Value here refers to how undervalued a stock is compared to the company's fundamentals. The more undervalued, the better. To summarize Lynch's third investment principle, mastering the timing of buying and selling is about returning to your original investment reasons and comparing your current holdings to other opportunities in the market. To summarize the content of this video, we discussed Peter Lynch's 3 investment principles. First principle, picking tenbaggers. At the start of his book, Lynch gives an adrenaline shot to all amateur investors. He believes that amateur investors are not at a disadvantage compared to professional investors in identifying blockbuster stocks. In fact, they may have an edge. To leverage this advantage, you need to learn a complete set of stock-picking methods, such as categorizing companies, for analysis, a process not as difficult as you might think. Second principle, stocks to avoid. Alongside learning how to pick tenbaggers, you also need to know how to avoid traps. In this section, we discuss certain stocks that should be firmly avoided. Steering clear of these pitfalls means you're already halfway to success. Third principle, mastering the timing of buying and selling. After discussing how to select stocks and avoid traps, the remaining crucial question is timing. There's a saying in the stock market, a novice knows how to buy, a master knows when to sell. Selling is often harder than buying. In this section, we shared Lynch's valuable experience in selling stocks. The 2 core aspects are, sell when your reason for buying no longer exists, and consider selling when you find stocks with better value. Finally, let's consider the standing of Lynch's investment approach in the investment world. Globally, Lynch is renowned for investing in growth stocks, especially in identifying tenbaggers, which often appear among fast-growing companies, turnaround companies, or asset play companies. Warren Buffett, another well-known investor, is also recognized for his stock-picking abilities, but he tends to focus more on steadily growing and consumer goods companies. Additionally, Lynch and Buffett differ in their concentration of holdings. When they find companies they like, Lynch might buy a little, while Buffett might heavily invest or even buy the entire company. In other words, Lynch's investments are more diversified. His Magellan Fund once held over 1,500 stocks, while Buffett's investments are more concentrated, usually involving just a few dozen stocks. However, for amateur investors, Lynch advises that holding 3 to 10 stocks is usually sufficient, a point on which he and Buffett agree. After 13 years managing the Magellan Fund, Lynch retired to spend more time with his family. His 13-year tenure, with an annual compound return of 29%, became legendary in the industry. After retiring, he devoted much of his time to philanthropy and public service. In investing, sometimes what not to do is more important than what to do. Knowing when to step away is a form of wisdom. Finally, let's remember Lynch's famous quote, "I want to think like an amateur investor as much as possible when picking stocks." His book is specifically written for amateur investors, so if you're one, congratulations, you're already ahead at the starting line. Congratulations on completing another book.